Hi there. A little bit of a delay due to some technical difficulties, but today I'm going to expand on protecting your income. So obviously protecting your income is important, but it is also important if you've made that decision to protect your income because you recognise it's obviously important because it pays the bills, that you then fully understand the different types of income protection that you can take out. Because they're all called income protection, but they're not all the same. Now, traditionally they were in two camps. One was an indemnity contract, so you advised the insurance company that you earned $100,000 and you insured up to 75% of that. So it was a contract of faith. You obviously didn't overstate your income in the expectation of getting paid more than you were entitled to, but you simply gave them the income and they then charged you the premium which was appropriate for that risk. Now, that was fine. You made application, you were underwritten, and the policy was issued. Now, at point of claim, you then went back to the insurance company and said, look, I can't work now, and I'm unable to work more than 10 hours a week, which is the normal definition of not being able to work. And you put in your claim. And so the insurance company gets the medical information, obviously, but they also want to confirm that you are actually earning the amount of money that you declared on your application. So the second thing that's happening with that claim is that they're going to ask for you to justify your income. Now, if you're on a salary and you get the same income week in, week out, it's generally quite an easy thing to supply because you can supply a payslip. The payslip confirms your income, and it's quite a straightforward exercise. If that matches the cover that you have on your policy, you have a claim being paid. Now, if you'd taken out the indemnity contract, that's what happens at point of claim. So secondly, you could take out an agreed value contract. So the agreed value contract, slightly more expensive, but it locks in the sum assured with the insurer. So the paperwork around your income is done at point of application, not at point of claim. So there is not the ability to insure as much of your income. So instead of going up to 75%, it's generally in the 60s, 65% of income. So you are guaranteed that amount at point of claim. So what you're doing there is completing half the claim, if you like, when you make the application, because you're then entering into a contract which says, this is what my income is. I've told you what my income is. Now, if I have a claim, on that information, you agree to pay it. So that doesn't matter then what you're earning at point of claim. So if your income has gone down, it doesn't matter as long as you're paying the premium. You will still get the benefit which you've insured, which is kind of comforting because if you're paying for something with an insurance company, it's always a nice feeling that if you have a claim, there's a good chance that you might get that benefit. So with agreed value, that is what's going to happen. You're locking in the payment of a claim sum with the insurer. So that was the simple way of looking at it. And then, of course, the insurance companies, as we know, they get better at designing products. And these products aren't just designed to make life more complicated for the consumer. they are designed to give this consumer choice. So now you have the loss of earnings contract. So you're getting a loss of earnings contract, which means that if you have an income of $100,000, say, and you have an accident, and ACC pays 80%, so you're now getting $80,000. The loss of earnings contracts will top up the gap. So you're getting an extra proportion of the 20% of lost income. So you can lock in with the insurer a top-up benefit for the loss of earnings, not just on the total earnings. So obviously, if you've got a choice, you do agreed value, loss of earnings, so that not only does your loss of earnings contract, not only does your income cover pay a set amount if you have a claim, but it also is going to top up any loss of earnings if someone else is paying as well, in the most obvious cases with ACC. So that's a process to go through when you're looking at the type of contracts. So then it comes along mortgage protection policies. Well, go back a few years, the mortgage protection policy was exactly that. It paid the mortgage. So, your mortgage was $2,000 a month or whatever. You insured that and it paid your mortgage if you were unable to pay it due to sickness or accident. Well, of course, the insurance companies couldn't leave that one alone, so they've now decided that you can have a mortgage protection policy even if you don't have an income, don't have a mortgage. Now, there are some advantages with this because it picks up the advantage of being agreed value, so it pays the amount that you've insured. It is a percentage of income, so it pays 45% of income, and that is agreed with the insurance company. So again, there's no need for declaration of income at point of claim. So the mortgage protection policy also, in some instances, has no offset. So if ACC pays you, you get your mortgage payment on top of it. So you're starting to get into an area where if you start to analyze the result of a claim, or what happens when you go on claim and how much money will go in your pocket and how that affects what you have to insure, income protection becomes a little bit more complicated. And quite often it's more effective for clients to insure their income as far as a mortgage protection policy is concerned than it is to insure just for standard income cover. Then, of course, it comes around to the issue of, well, how long do I need it for? So the benefits are payable for a whole host of terms. So 2 years, 5 years, to age 60, to age 65, and now up to age 70. So you've really got to sit back and look at the pros and cons of that. Now, for many people who are younger lives, getting it pushed out as far as you can provides you with the best benefit. Because we all don't think we're going to be disabled for the rest of our lives, but sometimes it happens. So if you've got the ability to lock in long-term income protection through to age 70, it's not a bad idea to do that. But then, of course, sometimes the cost is prohibitive. So then you can start looking at how long the benefit will pay. So you can get a benefit that will just pay for 2 years. Now, maybe 2 years will be sufficient as an income benefit to get you over the worst of a claim. And keep in mind that the vast majority of claims are less than 2 years. And there's very few claims that would go 5 years and beyond. And of course, if you've got a claim which goes 5 years or beyond, you're probably totally and permanently disabled. So then you've got issues around whether you just take the 2-year benefit, which saves you an awful lot of money, and divert the extra money that you may have spent having a longer term payout, and diverting that to maybe more cost-effective total permanent disability, which would certainly cover you for the situation that you were going to be on claim for certainly 5 years and beyond probably. So income protection can be a bit of a minefield. And all I would say to people is, if you're looking at income protection, look at it in relation to what fits for you best. And it could well be that a 2-year benefit which takes care of your income starting in a very short stand down period. So 4 weeks, straight into it, you get your income, it pays for 2 years, and then backed up with a raft of lump sum benefits from from total permanent disability and trauma covers or severe trauma. So it's not as simple as just picking a figure and hoping that it works. You really just have to understand what's going to happen at claim time. Because after all, it's at claim time that this thing is going to come into its own. This is the time when you're going to discover that it really does work, that it really does mean something to maintaining lifestyle, maintaining families, and keeping food on the table. So I hope I've given you the impression, I'm trying to give you the impression that income protection is a complicated product. But it's one which, if you take the time, you can very much get a product designed to provide you with the maximum benefit. And if for you, as I said, if it means that a 2-year agreed value contract will mean that you've got 2 years to sort your life out, if you're in the unfortunate position where it'll go beyond that, that's good. If you've got a 2-year benefit and you've got a illness or accident that you recover within the 2 years, well then of course you've still got the benefit going forward. And these short-term payout contracts, the 2 years, 5 years, they all are renewable and payable through to age 70. So if you've got a 5-year benefit, you've saved premium because you're not going to have a long-term payout, but you'll still get a 5-year benefit if you're 64. So please, if you're considering income protection, feel free to message me. I can give you an audit on your current program if you like, just so you know exactly what's going to happen. I mean, is the benefit going to be taxable? Is it going to be non-taxable? I'm not an accountant, so I can't give you that advice and say categorically. I'm not the IRD, so I can't necessarily guarantee that one contract is taxable versus another. It is a general understanding amongst insurance companies that the agreed value contracts would not be taxable. But then we have an insurance company in the market that firmly says, well, we don't necessarily agree with that, and you should take independent advice. So don't leave your income protection unattended, if you like. Get it out of the drawer and make sure that it's going to do what you think it's going to do. Insurance companies are constantly upgrading this product. And so having the latest version, the best version you can have, is always a must. Don't waste money on an old contract. If you can, get a newer one or a better contract, or at least know what the options are. And of course, as we get older, sometimes getting a newer contract just isn't an option because health changes and we get pre-existing conditions. But at least it is something which I think should be seriously looked at on a minimum of every 3 to 5 years. Because particularly if you're self-employed, the goalposts are continually changing on the self-employed. And for the self-employed, of course, there's ACC sitting there in the same way it's sitting there for the employed or salaried employed. But for the self-employed, ACC can be a little bit tricky because you always pay ACC levies on the previous year. So you've had an absolute blinder of a year. And let's use the current situation. You've had an absolute brilliant 2019. Everything was fine. The weather was great. You were able to work most of the days you wanted to, and you had an absolute amazing income year. So, of course, we now move into 2020. And it started well, but then, of course, COVID came along and maybe stopped your ability to earn. And so now you've got a situation where your income's decreased and the 2020 or 21 financial year isn't as good. So ACC will just take your last 12 months and you've got to provide your accounts. So, you know, if you're a self-employed person that's perhaps not quite up to date with the accounts, then there's a delay period. And so for a self-employed person looking at income protection, they should look at also their relationship with the ACC. And I would always recommend to clients who are self-employed that they look at Cover Plus Extra. It locks the benefit in with ACC in the same way as agreed value locks in a sickness or accident payment with an insurer. And this is a valuable exercise for the self-employed to do. So they can know that in the event of sickness, accident, that certain payments are going to come. Now, whether they come from a combination of insurance companies and the ACC, at least they know exactly what's going to happen. So there's my thought for the day. I haven't sipped my coffee much, but please feel free to message me if you have any questions about income protection. I'm quite happy to give you a quote. I'm quite happy to make comments around how I would structure income protection for you and your business or you and your occupation. Don't leave it to chance. It is too costly to find out that you made a mistake when you're making a claim. So thank you. Have a good day, and I look forward to discussing another issue with you next week. Thank you.